I just wonder, we went from saying that a supersized hike was something that was too aggressive to now maybe a 50-50 call. Does this U.S. inflation print increase the odds of that 50 basis point hike?
Well, as David said, there is no dove love in the U.S. right now. Even before the St. Louis chair came out with talking about a 100 basis point increase before July, the markets had already priced that. So I think the thing to keep in mind about the U.S. markets is, yes, we have super high CPI numbers at levels we haven't seen in 40 years, but the rates market in the forward space have already priced in all of this hiking. If you look at your Bloomberg terminal, you can see there are 160 basis points, 160, priced into the U.S. curve today for 2022 alone, going into midterms later this year. So no dove love here, but the forward guidance has already tightened rates, and the rates market, interestingly, is actually priced for a policy mistake / disinflationary outcome.
Yeah, it's interesting, as you mentioned, it's interesting to watch what the markets are pricing in beyond just that headline figure. But you take a look at where yields are for treasuries. I'm just wondering, do yields still have further to adjust right now? Or is there a sense that these hawkish bets on the Fed may have gone as far as they can, and likely we could be seeing some kind of correction?
Well, the forward yield curve, the 1-year forward 2s10s curve, you can see also on your Bloomberg terminal, fully inverted today. So it went negative, meaning you get paid more yield to own a 2-year bond versus a 10-year bond 1 year forward. And that's because of the 160 basis points that have been priced in to rate hike expectations. So the rates market is definitely saying, disinflationary outcome, policy mistake, and the Fed has already successfully tightened forward guidance just with their words.
So we've reached fever pitch, and I guess the half step forward question then would be, is it time to fade this sort of move now, this peak hawkishness move that a lot of people say we're at or close to at the moment?
So I personally think owning things that benefit from a steeper curve are one of the best risk rewards out there in the fixed income market, because you have so many hikes priced in that if something bad happens to the U.S. economy or to the markets or to the maybe a geopolitical, those hikes can just fade away. And I think it's important for investors to remember that, just 6-8 months ago, before the June FOMC meeting, Powell was saying we're not even thinking about rates. And then before that, we had transitory. And even in December 2018, when Trump was still president, the rates market had priced in 3 hikes in 19, and he actually cut 3 times. So rate hike expectations are often wrong. And I do think it's a very asymmetric opportunity to fade the Fed, because I don't think they're going to hike that many. 160 basis points this year plus almost 2 more next year in 23 seems like if they do that, it'll probably topple over the corporate credit as well as stock market.
Well, the other proposition would be then, do we then look at the rate hiking narrative completely divorced now from quantitative tightening and the shrinking of the balance sheet?
Well, I think that's what they should be doing, is shrinking the balance sheet, not doing the rate hikes, personally.
Okay.
They're tapering now, but they're still buying right now. But really reducing the balance sheet would help drain some of the liquidity. But I think it's also important for your audience to think about some of the inflation that we're having is not necessarily something that monetary policy can fix, because a lot of it is supply chain disruptions and the labor market shortages and things that are pandemic related. So we're really in, this is a new, Yvonne, as you said, it's a bloodbath over here, and this is new territory.